Before I get started today, I wanted to make a couple of requests and make an announcement. First, the requests. If you like these videos of mine and think that more people should see them, I'd ask that you make a comment in the comments section and give the video a thumbs up and also share it with others. The YouTube algorithm measures viewer engagement and it promotes videos to others based upon how engaged the viewers are. The second request that I'd like to make is related to a few comments I've received over the past year. It seems that quite a few regular viewers are missing content that I put out because they haven't checked the notification bell in the lower right-hand corner of the video. If you'd like to be notified when I put a new video out, please click that bell. I've taken a look at subscriber statistics, and it looks like only about 20% of my subscribers are being notified. Now for the announcement. I've taken a good hard look at my financial position over my winter holiday and have concluded that Phase 1 of my financial freedom plan is now complete. Those of you who have watched my Maintaining Discipline series of videos will understand what that means. So I plan to announce to my employer in late March that I will be retiring effective at the end of May, which will coincide with my 50th birthday. I have a lot more time, or at least I will have a lot more time available starting this summer to dedicate towards market research and financial planning. I will use this time to launch a new subscriber website. I still plan to put out free material on YouTube, but the subscription site will contain more frequent updates, will be more detailed, and will contain written content in addition to video. I've also started writing my book and have finished the first chapter. I don't anticipate making too much progress before I retire, but my hope is to have the book mostly complete by the end of the year. I'm thinking, though, that I'm thinking through the best ways to publish, and may produce physical copies as well as post the chapters as I write them to my subscription site. Your feedback on this is more than welcome if you'd like to submit a comment in the comments section. Now to the subject of this video. It's always good to occasionally reassess the relative value of assets to purchase with one's savings. Today I'm going to speak about how I currently view the market value of gold and the market value of the S&P 500 stock index. This chart, I think, really tells the story. You can see the price of gold and the price of the S&P 500 plotted as a function of time going back to 1970. Obviously, both have trended upwards over the past 5 decades, but there were better times to be in one or the other depending upon which decade you look at. The 70s were obviously much kinder to gold. The 80s and 90s were much more friendly towards stocks and unfriendly towards gold. The aughts favored gold, and the 20-teens were much better for stocks than for gold. You get the idea. Notice that the rate of increase of both the S&P 500 and gold have been remarkably similar to the rate of increase of the M1 money supply as well as currency in circulation. This is important. Notice that the CPI tracked currency and M1 up to the year 1982, when Greenspan was instrumental in changing how the CPI was calculated. Now the rate at which the CPI increases is much slower than perhaps it should be, and therefore those who use the CPI to deflate price changes may end up drawing faulty conclusions as it pertains to financial markets and to gold. I believe that the real driver of both increases in the gold price as well as stock market prices is the amount of money in the economy. I personally favor the use of currency in circulation for reasons that I've stated many times in the past videos. So let's take a look at gold's current price relative to currency in circulation. This chart plots the ratio of currency in circulation to the marked-to-market value of gold held by the U.S. Treasury. Notice that the ratio has varied quite a bit, but it seems to seek an equilibrium value of 3.82. 3.82, by the way, is the point at which all of the currency in circulation is about 1/4 backed by the gold held by the Treasury. If you recall, I've done many videos discussing how the Treasury considers the physical Federal Reserve notes printed by the Bureau of Engraving and Printing to be the first lien against the gold that it holds. Depending upon how circumspect people are in the soundness of the U.S. currency, this ratio has varied. In 1980, when we were in a full-blown currency crisis, the ratio went to 1. It was at this time that the U.S., if it chose to do so, could have gone to a 100% gold-backed currency. Now, over the following couple of decades, as the stock market roared, confidence was restored to the financial markets and to the currency, and the ratio of currency in circulation to the value of Treasury held gold rose to about 8.5. At this point, the gold in the Treasury only effectively backed about 12% of the currency. Notice where we stand now. The ratio is at 4.38. Is the currency as overvalued as it was in the year 2000? Not by a long shot. But neither is it anywhere near the currency crisis levels either of the 1980s. So, in a world of status quo, we're pretty close to where we would expect to be. The US currency is perhaps 14.6% overvalued relative to gold. The equilibrium value of gold is about $2,093 per ounce. Again, this is in the status quo world where the currency doesn't fall into question. But note that in the year 2020 alone, the currency in circulation increased by 16%. So even in the status quo world, the gold price should increase along with the quantity of currency printed. If confidence starts to crack, we may see much higher prices. Currently, gold would have to reach about $8,000 per ounce to be priced as it was in 1980, and many people think that this is ridiculous. They point to the fact that the current gold price levels were near the 1980 peak levels on a CPI adjusted basis. But remember, the CPI as measured is not keeping up with the money supply. We really need to deflate the gold price by the amount of money to get an accurate read. But what about stocks? How can I make the claim that the stock market is also driven by the money supply? Let's take a look. Here is some pretty compelling evidence. I've plotted here all of the forward 10-year rolling nominal capital gains from 1970 through the present against the ratio of the S&P 500 index divided by the quantity of currency in circulation. Notice that whenever the ratio of the S&P 500 to currency in circulation was above 1.4, the next 10 years resulted in below average returns. Notice also that whenever the ratio was less than 1.4, the subsequent 10 years produced a pretty good capital gain. I don't think this is an accident. Just like gold's price is a reflection of what's happening with the currency, the stock market is also a reflection of how much fiat money is out there. I personally use this model to guess what the stock market is likely to do over the next decade. Don't take this to mean that it's a good predictor of what the market will do next week, next month, or even next year. Nobody can predict that. If you encounter someone who tells you that they can, and that they can do this with confidence, then just smile and nod, just to be polite. So let's see what the S&P 500 index looks like when it's deflated by the currency in circulation instead of by the CPI. This chart speaks very loudly. The trend is stationary around the equilibrium value of 1.4. When the S&P 500 is plotted against the CPI, it looks like there have been 5 decades of real growth. But when plotted against currency in circulation, we see a story of stagnation, with periods of undervaluation and periods of overvaluation. Clearly, we can see here the period of the late 70s and the early 80s where stocks were cheap. We can see the period of the mid-90s to the early 2000s where stocks were quite expensive. What is interesting is we can also see here that in 2008 the stock market was about as overvalued as it was in the early 1970s. Where do we stand now? The ratio is currently 28.6% above its equilibrium value of 1.4. This means that the fair price for the S&P 500 is about $2,929 instead of its current price of $3,768. Does this mean that it will fall to $29.29 next week? Not at all. It could, but that's not guaranteed. Remember, the currency in circulation is not stationary. Last year it increased by 16%. If it continues to increase at this rate, then the equilibrium price for the S&P 500 could catch up to the market's current pricing within 2 years. So I wouldn't shun the stock market right now. It's still probably a better place to preserve purchasing power than the bond market. So in summary, neither the price of gold nor the price of stocks is completely out of whack when viewed from the lens of currency and circulation. I'm still maintaining my target stock to gold mix of 65%, 35%. Is it a perfect formula for getting rich quickly? No. Is it a reasonable mix for getting rich slowly? I think so, and my boss is going to be hearing from me soon.